we've got this first slide here, which shows kind of a chart over time of tokenized equities, tokenized stocks. There's been a lot of talk. We're definitely Bitcoiners from the Bitcoin space. DeFi is always there next door to Bitcoin, right? And so there's been a lot of talk over time about how do we bring up more of these real world assets, equities, fixed income, etc. How do we tokenize them, make it easier to ship around? In theory, it should be instantaneous or close to it. It should bring down the cost to make some of these trades as well. But Matt, I think you had an interesting take on where this goes and how this is actually kind of part of that monetary battle that we were talking about between the different types of systems that are out there. So I'm going to turn over to you, Matt. But just to kind of give us the rundown here, this is just a chart of different ETFs, equities, that sort of thing, that are tokenized already. As you can tell, it's been rising over time, but we're over $1.4 billion of value, in quotes, that are tokenized as of today.
Okay. So yeah, you look at that trend and it's like tripled since I think this chart starts January 2025 and
Yep.
the data sources here, there's no central authority. You just
Yeah.
small shop just tries to
I
piece
think
this together, but it
RWA does
shows
a
you
decent job. They try.
okay.
Right? Like, yeah. But
It shows you where trend is, right? Any trend that's growing like
yeah.
300% in a 1 to 2 year time frame, it's like, oh, I know how this works. We worked in hyperscale, big technology firms in the 2010s, right? This is something well familiar to us. So, all right, I want to focus here specifically on U.S. securities markets, but this broader tokenization trend. What it's really about, in my mind, is all right, you're taking those valuable claims, and it starts with the Western Hemisphere. Like you're talking about, oh, let's go to Canada's resources. Let's tokenize the timber, tokenize the minerals, all of that. What you're actually doing is you're putting the claim on these assets inside of a wrapper, and then that value can be extracted from, I use the term onshore, but extrapolate this, like think about Western Hemisphere. You can then pull the value of that asset, just by trading it on these offshore crypto platforms. And then that value can be used to collateralize, monetary creation, dollar creation, these, staking, DeFi, yield farming type of protocols. All right, my point here, I want to specifically focus today on US equity markets, right? What this is really about, the tokenization, as I read it, we're putting claims on these valuable Western Hemisphere real assets. And it doesn't have to be just Western, like it could be the Russian commodities, right? Like $75 trillion is some of the numbers I've seen thrown out on what is the actual mark-to-market value of all of the natural resources that Russia is sitting on, that legacy financial systems would love to have pulled into the collateral on their own fractional reserve scheme. All right, so what's happening here, in my view, you're siphoning off value and being able to pull that collateralized and offshore platforms value, right? And that value then is then that activity leaves the domestic financial system or its economy.
Right.
All right. So yeah, so we see this trend. It's 300%. This is real, and it tells you like where the puck is going, and my opinion. So what's happening as it stands right now, the early platforms out the gate are all going to be like crypto spin-ups, right? Like very loosely regulated, probably mapping, as you look into, they're like, oh, this maps to British Virgin Islands, Caymans, et cetera, one of these offshore money center or secrecy jurisdictions. But the US capital markets players, like the legacy institutions, they know this trend is coming. So you've seen in the last like 2 years, they're getting ready for this. So the natural defense to fight this trend, if you're the United States, or just more broadly, think about them as the Western Hemisphere's like regional sponsor, is to adopt this blockchain style infrastructure themselves. So what you need is faster settlement, more efficient back office operations, and then you got to be able to match like the product features that these platforms offer, like 24/7 trading, and then settlement times reduced as close to real time as possible, right?
Yep.
And then what's going to win out now, the US has, in this arms race, apples to apples, technologies, all of that, and products to meet what you're seeing on that chart. It's only $1.4 billion, which is one small cap equity at this point in US capital. It's like a Russell 2K,
Yeah.
number 800 out of 2000 or something. But where the trend goes, if you keep doubling every year for 5 to 10 more years, you can see it's like, oh, this is where the market's heading, and this is where the prize is. All right. So you see this in the headlines. So 2025, you saw the back end players like DTC, the NSCC, and then the SIP with the
Market data providers.
yeah, yeah, exactly, that are the kind of the backbone that U.S. capital markets and exchanges and brokerages are all built on top of for settlement and custody services. Um, and then in the last few months, you've seen like the next level up, the exchanges themselves. So NYSE, Nasdaq, CME, et cetera, have all started to signal their readiness. And they're like, we're going to launch this 24/7 trading. It's, when is the date? What's on the project roadmap? But it's like this is going to happen way faster than all of us, I think, are broadly even aware to right now. Like it still isn't baked in. And just for comparison, to tell you how fast this is moving. So I want to say it was 2022. Corporate bonds used to trade T+2 settlements. So if I traded a bond today on Thursday, we technically settle 2 business days away, which is technically next Monday, right? This is the way bond markets have traded. At some point we moved to T+2. It's probably been like 40 years, that the whole market has operated this way. 2022, we brought down corporate bonds from T+2 to T+1 and matched the T+1 settlement that the U.S. Treasury market has operated on. But that was like to go from T+2 to T+1 settlement in 2022, just like 4 years ago, was a huge deal for the back end, the back office side of the U.S. financial services industry. Just to tell you in context, within like a year or two, we're going to have this real-time 24/7 settlement available. So like the speed of this, like if you think about transitions gradually then suddenly as you're moving up that S curve, we're still like, I don't know, just traveling up the first part of that S curve. But like when it happens, it's going to be like it's gonna change things very quickly. In my mind, is how this looks like it's developing.
Yeah.
All right, so this is a key battle in the broader capital war that we're talking about as this big geopolitical power shift, this transition of the post World War II order, all of that is taking place. And the U.S. capital markets, New York, can't afford to lose this. It's too important not to. So they've clearly been monitoring the situation for some time. They're not asleep at the wheel anymore. This is coming, and like they're well on top of it. So that early chart of the RWAs, specifically security tokenizations, U.S. domestic capital markets, like they're not going to fail here to the typical innovator's dilemma problem where challenger comes up, disrupts from below. It's like, no, they're going to integrate these, call them blockchain technologies. I don't like using that term because there's only one sound and solid public blockchain, and my point of view. We'll just get into this later, but yeah, think about this as like private closed-end blockchains, and they're building on top of that. And one of the main reasons that we could only do T+2 settlement and corporate bonds, just 4 or 5 years ago, is the systems were just old, archaic, 40 years, 50 years, put in place and past their useful life. And now the industry is building on these new rails. So yeah, we'll go to slide 12. So now, because securities and commodities, when they trade, they ultimately have to settle in the money, right? You trade, shares of Apple in US dollars, right? The next question is, where does final settlement move, right? How do these brokerages settle, the dollar side of those transactions? And this is, I think, where we're getting into the rubber meets the road of the core of the problem that we've been getting around for like 15 years, ever since the GFC revealed the broken structures at the level of reserve settlement and cross-border capital transactions. All right, so slide 12, this was a report from the BIS last June, but it hints at the legacy kind of systems vision of where they see this going. All these things we're talking about, tokenization, cryptocurrencies, blah, blah, blah. So This report imagines these tokenized platforms where central bank reserves appear as the settlement foundation, right? So we've talked about the difference between the ECB's route going a CBDC as a public reserve money, right? The the settlement good or the base money at the core of your monetary system is something that the private sector doesn't have access to, right? It's an outside money. It sits outside of the access to households, businesses, et cetera, versus the stablecoin route plus Bitcoin, right? Stablecoins, your private money issuance from a commercial bank or a regulated entity. Genius Act put that framework into place and made it law of the land. Um, with something like Bitcoin, or it could be vault gold, whatever, but it's an inside money. It is inside the hands of the private sector. So you see the BIS, they're telling you this is their core business. Like they're trying to staple on the old framework onto the new and say, no, you're just going to need these, central bank reserves to go along and settle money on these things you're building, guys. You need us. So tokenized central bank reserves and their framework would like support the final settlement of like private monies coming out of commercial banks or regulated trust issuers like Circle, USDC, all of that. And then they say specifically tokenized government debt. So um, what is tokenized government debt, right? Well, we've already done that in the US with the stablecoin, right? You got the stablecoin dollar under the asset-backed definition sitting on top of the Treasury IOU. So we've already like solved our way around part of the problem here in the United States. Um, and I just want to put this into context. Slide 13, this is signal on what the US firms are doing. And I think you saw Charles Schwab made an announcement in April. They're going to onboard on their own brokerage platform. Charles Schwab is one of the biggest, brokerages in the United States. And think about it, it really like disrupted the incumbents, whatever, 70 years ago, when it went to discounted commissions on its model. So you think about a stock trade back in the old days, it was only done by the very wealthy men, and they charged, I want to say the average commission was $100. So you got to be buying in size at a time when this is under a prior dollar era when money supply was much lower. So $100 back then was a meaningful, chunk of change. And what Charles Schwab did is they sped up the back office. They invested in productivity, data servers, technology, all of that. I said, we're going to bring the price down. We're going to cut it from $100 to $7. Rest of the industry said, you're crazy. You're going to lose money. Turned out they didn't. And it actually made more money for everybody because they showed everybody, get more productive. You're going to expand volume and you're going to make way more. And, that's, that US equity markets took off as we expanded access from lowering costs, right? And that's, that's why all technologies get adopted at the end of the day, right? They should be giving something of value at a lower price point. That is how the innovator's dilemma framework works. I keep bringing that up today, but I didn't mean to. It just is like part of the theory.
Yeah.
It's like, all right, you meet the same use cases or offer new use cases where you can provide value, and then you do it at a lower cost. So the same thing, the way that Charles Schwab disrupted the brokerage industry, whatever, 60, 70 years ago, this step to bring Bitcoin in, I see that as cut from the same cloth, right? Because what is Bitcoin? It's this open reserve settlement solving this Byzantine general's problem. But instead of a centralized counterparty, you now have no trusted central intermediary. So we're not going to move to a world where your Apple shares are going to be priced in Bitcoin, tomorrow. Just because you got to go through two bid-ask slippages, right? You got the bid-ask on Apple to USD, or increasingly that trade is going to take place and be settled in stablecoins and stablecoin dollars. And then if you wanted to price it in Bitcoin, you'd have another slippage with the bid-ask on Bitcoin to those same Genius Act stablecoins. So you're paying a bid-ask twice, so it wouldn't be the most efficient in my framework. But as this process goes on, and if we keep, checking off milestones on this vision. You can see this monetary transition as the Scott Bessent framework is laying out. What's coming next? Stablecoin reserve. Well, what happens when you have a stablecoin reserve? Oh, now we can start indexing the dollar and moving down to peg to that as a real asset, or it could be gold, could be whatever. But then you start laying the groundwork where the U.S. economy and its financial system can move the pricing of and settlement of all this securities volume and capital markets that's taking place in the U.S. economy, but then also have the apex currency like it did under the gold standard post 1875 when we remonetized the greenback or repegged the greenback back onto gold, and then it was just like golden age, right? You get into the Gilded Age, robber barons, industry, all of that. So I think that's the way I see this shaping up. But this real world assets, the tokenization, what the U.S. financial industry is doing, it's part of this story, the monetary transition that we're trying to describe on a weekly basis as it unfolds. But I would say the big picture story here, as I'm reading it, the new world of the Western Hemisphere. This is like a multi-century story, right? Where these colonies, they're now standing up for themselves, and they're not colonies anymore. They're sovereigns, right?
Yep.
And they're taking that power away from the old continental order. The BIS is central, clearinghouse for the central bank-based, monetary cartel, really established the legacy liability-based dollar framework. All of that is under transition. It brings us back to that first topic where we started out. What would you be looking for signs of who's winning this tug of war? We talk about tug of wars often. I think about stock charts as exactly that. When you're looking at who's winning the bulls or the bears, think about it. The purchasing power erosion has got to hit somewhere, right? Like the loss of a production market or access to oil inventories or commodities coming out of the Persian Gulf. That shows up in the nation state, or EU is beyond a nation state. I don't even know what you call it, a super sovereign NGO, whatever, the EU SSR. But the purchasing power loss in this currency would be a sign that this shift of capital markets center of gravity. We don't talk is it going to New York? Is it going to Shanghai? We'll talk about that later. That's a battle we won. But I think what we can say right now is the horse that's immediately leaving the barn right in front of us is that center of gravity is leaving continental Europe. It's leaving Basel, leaving Frankfurt, leaving London. That looks like the near-term horizon. We'll talk about where it goes later as the who takes up that future center of gravity. But for right now, we know I would say my conviction, high probability. It looks like that center of gravity. It's leaving continental Europe and the old world.
Well, with that,
So
yeah,
yeah,
I was gonna say, I think that you summed it up perfectly right there, and I also want to call out. I feel like our set of topics for this week, they really felt like they all intertwined and really pushed forth that mind print hash narrative that we've been talking about.